Hello everyone, welcome to CA Club India. I am Muskan Mudgil, a content creator at CA Club India. Today we have with us CACS Ujjwal Jindal, who is the co-founder at UJ Legal LLP and his experience in the field of direct and indirect tax laws, corporate, secretarial and allied laws, capital markets, etc. So before we start, in today's webinar, he is going to discuss the expectations from the Union Budget 2022 and 23. So before we start, I would like to inform everyone that this is a speaker session. In case you have any doubts, you can put them in the chat box and sir will try to answer at the end of the webinar. So over to you, sir.
Thank you so much, Muskan, for the wonderful introduction. And thank you so much, CA Club India, for inviting me once again. I guess we are meeting after long. My last webinar with CA Club was in November. And since then, we have been busy in the professional commitments and everything. So I guess it became a little difficult for us to conduct a session. But yes, we are nearing with the budget and everything. Everyone has started to compile information about what the expectations are or what will actually the budget be. So in today's session, we'll be highlighting what expectations do we have as a professional or as a taxpayer from the union budget. We are also going to have a detailed discussion about what are the provisions that are there in the Act that are asymmetric or that are not consistent with the other provisions that have been notified. So today's webinar would be like a gist of what we want from the government. So the recommendations and the accommodations part that we have from the government. And secondly, we will also be covering up that what are the consistencies that the government wish to achieve. So not taking much time, I'll start the presentation. Let me quickly start up the presenter. I guess everybody is able to see the screen. So let me begin immediately. By not wasting much time, I want that we should complete this session today well within time. Okay, so we have key expectations from the Union Budget 2022 and 23. There are few of my details. You can take note of them. I'll also give this detail at the end of the session, and you can contact me if there are any queries that you have in this regard. Okay, so scope and coverage, as I already said, we are covering up the key expectations from the Union Budget. We are also covering, just give me a moment. Yes. Yeah, we are also covering a list of apprehensions and recommendations for the upcoming Union Budget 22-23. And thirdly, we will also highlight the asymmetry and conflict between different that should be plugged to bring in more clarity in the tax and allied laws. So I have focused this discussion primarily on the direct tax components because that there are certain things that have been revolving in and out around the indirect taxes and the other taxes. So today's session will be focusing on the direct tax component more. However, if there is anything that is of much substance or I see that there are things in the indirect tax also that we should cover in this webinar, we'll see if their time remains at the end of the session. Okay, so for now, I mean, if I say for the beginning of this session, so I'll be taking up this particular thing. So quickly moving, what the first expectation we have is for the realignment of income tax slabs and increase in the standard deduction. You must have seen this, that that the primary exemption limit or the deduction limit for the individual should be increased, the slab benefit should be increased, and simultaneously there has been much buzz that this time the standard deduction, which was 50,000 rupees financial years, that should increase to 75,000 or 1 lakh. Probably we are just expecting, we can only count upon the government that how much would be the next standard deduction or how much would be the tax slabs. We are just explaining up, or we are just considering that the government consider our views, our expectations, because I know some or the other way CA Club India is a big community and this must be reaching out to many, but already the budget is has been finalized and there is no scope that things could change now. But let's hope for the best and let's study what the provision or what the realignment should actually be. So I suggest for the first time that the basic exemption limit is 2.5 lakh. I am not talking about for the people who are senior citizens or who are super senior citizens. The deductions vary simultaneously. The slab benefit varies. Like for 60 years, it's 3 lakh. And for 80 years and above, it's 5 lakh. So I'm talking about the basic exemption limit for the normal individual who is under the age of 60 years. So for him, the tax slab is 2.5 lakh. And we recommend, or we want that this particular 5 lakh. Now, everybody else in this audience or whoever is listening to this, that currently also we are not paying any taxes if the total income component is 5 lakh or it's up to 5 lakh. So for that, why it is not 5 lakh? That is because of the rebate that has been provided, the income tax rebate that has been provided by Section 87A. Now, this rebate basically or classically says that if your total income is 5 lakh and it is not exceeding 5 lakh, so the tax payable by you on the 2.5 lakh portion, that is 2.5 lakh is the basic exemption, and you earn any income that goes up to 5 lakh rupees, 12,500, because there is a slab, there is a tax rate of 5% on the another 2.5 lakh up to 5 lakh. So that 12,500 would be rebated for to the extent of 100%, and you don't have to pay any taxes for the same. However, if that tax remains a lower side, like your total income is 4 lakh, so proportionately you will get the amount of deduction of tax that is available. So the maximum being 12,500. But it comes with an exception or a condition that the total income should be up to 5 lakh only. If even your assessee or client or person is having an income of 5 lakh 1 rupee or 5 lakh 1,000 rupees, so in that particular scenario you'll have to pay this particular 12,500 on the 2.5 lakh to 5 lakh total income. So this is a major flaw in this particular thing, or the government own interest. So we feel that this exemption slab should move from 2.5 lakh to. Next, about the standard deduction. So currently, as I said, that the standard deduction limit is 50,000 per month, which is significantly low seeing to the cost of inflation over the years and the living expenditure of the salaried individuals in current time. So we expect that due to the increase in the medical expenditure component or the electricity bills or the cost of inflation, this particular standard deduction should move up from 50,000 to a certain respectable amount. That could be even 75,000 or that could be 1 lakh. So it will all depend upon the government's policy and government's decision on the same. But there should be an increment, and we are expecting an increment on this. If we see that standard deduction was basically brought in just to counter for various of the deductions or exemptions that were earlier provided under the Income Tax Act. Now, to add on further, what were these? Cost of travel, cost of medical, cost of transportation that was borne by the employer or was reimbursed to the employee. So to cover all those under a single umbrella and not to devise separate laws for each and every assertion, the government produced for the standard deduction that whatever nature of work you have, or whether you are actually being paid those allowances or not, you will get a standard benefit of 50,000 rupees. Now, what the only thing is that this 50,000, like it has been there from like past many years. So the inflation effect has not been taken up with on this standard deduction limit. So the standard deduction limit will have to like go up. It has to be increased from the current to like 50,000 to the 75,000 or 1 lakh limit. So we'll see like in future, we can only expect that good things come to us, and we expect this to increase up to 75,000 at least, or the maximum is 1 lakh that we could anticipate. Moving towards our second expectation or recommendation, that is tax relief for COVID-19 patients and their families. So we see that earlier there was a press release on 25th of June 2021. So saying that the taxpayers receiving financial help from the employers as well as well-wishers for meeting the expenses incurred on treatment of COVID-19 get an income tax exemption. Thus, any amount received from employer or any other person for treatment of COVID-19 would be tax-free. So this press release was already in stance starting from the 25th of June 2021. So further, if a taxpayer dies, this is also a part of the press release itself, that if a taxpayer dies due to COVID, then any financial assistance received by his family member shall be exempt without any limit, where the financial assistance is received from the employer of the deceased. However, where the financial assistance is received from any person, the exemption shall be limited to rupees 10 lakh in aggregate. There would still be an exemption, but the total exemption amount would be 10 lakh, and any amount received more than 10 lakh would become taxable. So now, why we are saying that this relief has to be like a recommendation for the government, because it's already in practice by virtue of the press release. So that is because this press release said that there would be the legislative rules that would be accompany this particular deduction or exemption would be notified in future. And they were to be notified, but till now they have not been notified. So I guess by the budget, particular assertion would get notified and everybody would be able to legislatively take the full benefit of these provisions. However, if you are planning to take the benefit of this provision even now on the basis of the press release, we can do that. But the legislative effect or the statutory notice effect, notification effect should be given to this particular provision. And that is what is the recommendation, that for abundant clarity, the tax treatment may also be specified as taxable in the hands of employees. So this is just a clarificatory thing that the government should produce, and produce the entire section as a part of the Finance Act 2022. Moving towards the third one now, that is separate deduction for COVID-19 treatment vis-a-vis section 80D. Now, I really think that the cost of expenditure on the treatment of COVID-19 during this entire 2 year period has been immense. The bills have crossed like 2 lakh, 3 lakh, 4 lakh for a particular person, or even higher in case they were severe. So we have all faced a lot of tough, and I guess this financial year or this budget is primarily, or should primarily be, for those people who have already suffered a lot, who have lost their someone special, or they have incurred so many expenditure that the government should think about actually giving them a tax relief. So we are talking about a separate deduction treatment. So all those who have incurred expenditure towards this disease should be given an additional expenditure over and above what has been given under section 80D, because section 80D is again very lesser amounts have been allowed, and secondly the base is for the payment of the medical insurance. Secondly, I would also ask everybody who is watching, or their friends, or whoever the clients they guide, that please insist your clients or your family or your people to buy a health insurance as soon as possible. This is not a one-time thing. This is an expense, an asset actually, that you should book in for the future coming up happenings. Because what happens is, at the moment, spending, see, you might have money, but spending that immediately like 10 lakh, 15 lakh is a little tough for everybody. So what we do is we just spread this particular exposure over years, and that is by what we call it basically premiums. So you can buy in for any policy, but at least have a health policy of minimum 5 lakh rupees or more, depending upon your particular preferences. So I insist everybody to buy on a health insurance. Okay, so 80D, as I was talking about, that there has to be a separate relief for COVID-19 treatment, and the 80D limit should also be increased. Why I'm saying this? That I already talked about the deduction about the insurance premium. So if you are paying in for the health insurance premium of your own family or for your dependent parents, that the allowance is, if we see that if you're not covered by any health insurance plan, and if you have paid certain amounts, then in that particular instance, what would be the situation? For senior citizens, the government has already had a deduction under 80D, where an amount of 50,000 can be allowed in case of those person who have not taken a medical insurance policy. So there was a two condition, that the insurance policy has not been taken up by that particular individual, and second, the amount has been expended non-cash. So it has to be paid like without cash. In that particular instance, the senior citizen or the person who has paid the particular amount, senior citizen, he can claim up for a deduction under section 80D for the amount of fees. Now this particular deduction is not available to a person who is non-senior citizen. So what we say to the government is that you allow this particular benefit with a higher limit to even the persons who are non-senior citizen. Same benefit, same everything, no much of stance, just increasing the amount, and secondly, to everyone, like one and all, not just the senior citizens. So that is the small thing that we are demanding from the government. The slides and everything, if you want, I'll post it back to CA Club India, and you guys can save it either in the YouTube link that we put on the YouTube after this webinar, or they'll also mail it to you, or you can write it to me also. You can study these slides. They are well in detail. I'm not going each and every word by word. However, I have prepared them. but we are just covering the gist of everything, and I have already covered what is written in the slide, so you need not worry. If you are listening to me, it's more than sufficient. This is just for a presentation purpose. Next, we talk about increase in deduction under section 80C, that is investment link deduction, payment link deduction. Okay, so we are talking about that now. So the populous deduction under section 80C of the Act covering common tax saving investments has a higher cap limit of 1.5 lakh, which has remained static over the years now. So from many years, we have been listening 80C limit as 1.5 lakh, 1.5 lakh, 1.5 lakh. But from the, like, if we see the past trends, the income, the inflation, everything has increased, but this 80C limit has been stagnant. More particularly, this 80C more specific, like what the government thinks is more specific to investments. However, it is also the same for the payments. Like if we want to repay the loans of against your house property, or if you want to repay, like if you are paying tuition fees at school for your children, so you also claim deduction under 80C for the same. So 80C is a basically a basket of deductions, I should say. It is not a single section, and a deduction equivalent to 1.5 lakh for the entire financial year for a particular person is really less. So I insist, or we insist, or we recommend the government particular deduction. And I see much stance in this that the standard deduction thing and the 80C, these are most probable to be increased because of two reasons primarily. First, they are actually very low. Second, elections are around the corner. So I guess the individual or the taxpayers would get the desired benefit for these particular two variables. Like they can definitely get a higher tax slab or a higher tax limit in particular, or in particularly for 80C. I'm so sorry for the phone call interruption. So next I have added in the 80C that again there should be for the education, there are schemes or there has been proposals in the 80C that primarily talk about the education of the children or education of the persons, but again it's under the basket of 1.5 lakh only, as I said. So for the education sector, for educating, this particular deduction should have been given separately. Either you can have a limit increase under 80C, or you can give a separate deduction for the school coaching fees at least, because that is higher. At the time I was a kid, I was at school, the quarterly fees, I guess my parents paid was around 5 or 6, 4 quarterly. Now the fees is like over 20,000 if you are studying for a month, if you are studying in an international school, and if you are studying in a national school or a domestic school, even then it is 10 to 15,000. So it's no less a stance, and that over the entire year it goes exceeding 1.5 lakh. So the total benefit is not coming. However, one should focus that for the tuition fees component under the 80C. Whenever you are paying a children fee, it has many components. If you see that fee card that they provide, so there is development fee, education fees, etc., etc. There are so many charges or so many heads that have been created by the schools. So those particular things are not getting covered anyway under 80C. Only the amount that is paid for the tuition fees is getting conferred under the 80C. So one has to see that whenever you are booking the deduction, you are taking the right benefit, because under scrutiny assessment, otherwise your claims can be rejected and you'll be made liable to pay interest and penalty side by side. So this you have to also take care about. So 80C, moreover, ATD, as we know, is available only to the legacy schemes, like the old income tax regime. Tax regimes, it has been done away with because the exemption or the deductions are not allowed under that scheme. So whatever we are talking about deductions, I'm primarily talking for the legacy tax scheme or the old tax regime. So people under those tax regime have to actually worry for these things. Others can anyway ignore, because they must not be investing in these particular things or making payments under this thing. Okay, now a very interesting thing, that is deemed leave travel concession LTC and a cash voucher scheme. So this scheme was lately introduced in the it came in the year 2020, or 2020 it came up. So the resurgence in COVID-19 FY 21-22 further hampered the travel within the country due to restrictions imposed by state governments. So we are going under the financial year 21-22, and we could see that there are certain travel restrictions that are prevalent, and there are certain things that there are conditions that a person cannot travel much, and LTC is all about the travel concession part. So further, the recent surge in Omicron variant has put the travel on hold, which may continue to the next financial year also, because there can be instances that the lockdowns and everything would not be uplifted, or due to health issues or certain preventive measures are going to travel so much. Therefore, the deemed LTC cash voucher scheme, which was introduced by Ministry of Finance in October 2020 to boost the consumer demand and tax benefit to the individual who was unable to claim the usual LTC tax benefit due to COVID-19 restriction, should be considered to be extended to 2 more years, that is till 31st of March 2023. Why 2 years? This scheme was applicable only till 31st of March 2021. Now I am saying this to continue this particular scheme starting from 2022, like 31st of March 2022, 31st of March 2023. Let's have a gist about what this scheme actually is. So brief about this scheme. The government announced an LTC cash voucher scheme that allowed taxpayer for LTC, LTA to claim the allowance tax exempt without traveling by purchasing goods and services as per the scheme and as per the scheme's conditions. What were the conditions? As per the scheme, an individual had to purchase goods and services attracting GST of 12% or more by digital means between October 2020, 2020. This is 2020, not 2022. There is a typo error in this. So 12th of October 2020 and 31st of March 2021. Within this period, you have to purchase this particular thing which are attracting GST at the rate of 12% and above. The individual would then be allowed to claim 1/3 of the amount of the bills as tax exempt LTA or LTC without submission of travel proof, subject to a maximum of INR 36,000 per family per member. So this condition is per family member. Don't get confused. I guess we have had a brief about the scheme already, so you know what are the terms. Let us take an example quickly to understand this cash voucher scheme. It's very easy. It's really simple. And we would take just 2 minutes, I guess, to understand this by way of this illustration. So let us say that you have purchased a tab or a laptop for 39,000, inclusive of GST at the rate of 18%. So that is like higher of 12%, 12% or higher. So we have taken it at 18%. Now the amount you will be eligible to claim tax exemption for will be the lower of one of the following. So first condition that is coming is the 1/3 of the amount spent. That is 39,000 divided by 3 becomes 13,000. And second condition is 36,000. Okay, so whichever is lower again. So thus in the above example, you will be eligible for the maximum tax exemption as a leave travel concession to the tune of 13,000 rupees. It's primarily to remember that this exemption is for 30,000 and a family of 4, say suppose, can claim it to the tune of 1.44 lakh, that is 36,000 into 4. So this is all about the cash voucher scheme. I am who were not clear about cash voucher scheme, or they were not knowing because they are not entitled to this particular allowance, they would better know about the cash voucher scheme just for their information. Next, moving toward further relief for senior citizens. So senior citizens were worst affected, I guess, due to COVID, because their health condition was already in a condition that they could not sustain any of such viruses that are entering their body. Secondly, they had limited means of funds available with them, like most of them, not all of them. So most of them have. So what do we have a takeaway in this particular thing is, what the government should do is, we are asking for further relief. There exists a relief by way of Section 80 TTB. So mostly investments are in the form of savings, and saving deposits, they reap saving bank interest and fixed deposit interest that is coming from banks, post office or cooperative banks only. So if there is interest that is coming up from other sides, that is not tax exempt under section, that is not tax deductible under Section 80 TTB. If they wish to attain this particular deduction, they have to only from FD or fixed deposits or deposit that are earned by that they have kept, they have booked with banks or the post offices or the cooperative banks. So there was already a deduction on this, but we want this particular deduction to be, because 50,000 is again a lower amount. For individuals in this particular senior citizens, we have a condition of 10,000 rupees just for the saving, that is 80 TTA. Even I feel even that is low. And why are we not allowed the benefit of having interest exempt of the fixed deposit part? So I to allow this particular 10,000 in the within the 10,000 relief, even allow for FD interest to the tune of 10,000, like saving and FD both to the tune of 10,000. Like just the same condition as there is in 80TTB, amount can be kept lower, but at least include that amount in 80TTA also. For 80TTB, we are asking for a higher amount. However, be like I'll ask for 1 lakh or a higher amount, but 50 lakh in between any amount would do. That would do more justice to all the senior citizens. The next thing, introduction of tax regime for cryptocurrencies. I know all the professionals, investors are really interested or excited to know about what would be the tax treatment in case of cryptocurrency. For now, investing in cryptocurrency was not allowed by government. It was illegal. Lately, this ban and everything has been, you must be knowing that many of your people have started to invest in cryptocurrencies. They are buying bitcoins or other kind of coins that are available as cryptocurrency. So in this particular finance act, I'm expecting that things to come up, and they have to. Is the voice not audible to me or everyone else? The voice is audible to everybody? Okay, perfect. So introduction of tax regime for cryptocurrencies is a much important thing, I guess, and this budget would definitely introduce this particular thing. We expect this to happen for sure, because cryptocurrencies is again what we say as shares or mutual fund. It is or a currency instrument. It is already an instrument because it's traded on stock exchanges. However, it is not exchange. It is not something that is of like recognized for now. That is why we are anticipating a bill or a tax regime to come, like what would be the taxations, how the tax would be paid, what are the TDS TCS provisions, how this would be reported. So we have prepared a small study on how this changes would be there. So as per the recent studies, India's cryptocurrency market has seen an exponential growth for over past years. It is a 1808 crore investment that the Indians have made in the cryptocurrency, and it is expected to go till this much amount till 2030. So currently, India has the highest number of crypto owners globally at 10 crore, at 10.07 crore. So you can see how many Indians are actually investing in Bitcoins. A bill was expected to be introduced during the winter session of the parliament, but due to all this fiasco of the COVID, it was delayed. And we now expect the bill to come up. And up to my understanding, I believe that this tax regime would be a bit regressive, because the gains are really big in case of cryptocurrencies. We have seen it. So what I expect or anticipate that the government would be adopting a regressive tax policy. What policy? It is like they'll be charging up more tax to the tax, a higher tax category scheme. But this is just an assumption. I don't know whether they wish to allow us or promote this particular cryptocurrency thing in India. So probably things could change, but that is all dependent upon what the government policy is and how things would go. So considering the size of market, the amount involved, and the risk coupled with cryptocurrency, it is expected that the following changes may be brought in the taxation of cryptocurrency. So now we are enlisting for those changes that would be brought in for the cryptocurrency, and the first amongst them is TDS and TCS, because we know like transaction trailing or transaction footprinting has been the prime objective of the government to track on the revenues, and that is for TDS and TCS provisions are very important even for the cryptocurrency thing. But this TDS and TCS provision to talk is easy, because these all the exchanges that deal in cryptocurrencies, or all the depositories or the specified participants who are there in this particular process are belonging to out of India, or they are outside for now. So now fetching those particular details, or how the TDS TCS provisions would be entailed on, or how the government would be taking up the TDS TCS provision is a big is a big thing that the government has to produce for the rules, and everything for the same should have to be produced. But yes, TDS and TCS is an important component that the government must be focusing if they are planning to bring in the cryptocurrency thing. Next is the reporting. Now we see that this statement of financial transaction, that is SFT, that you will be able to see also in your form 26AS, and also there has been a SFT statement this time in the previous financial year. However, it was shunned by the government that they are not taking that particular stance for the previous financial. starting this financial year, that is 21-22, they'll be believing the statement of financial transaction. And in that particular financial transaction statement, the reporting of this cryptocurrency gains, like we see of shares, of mutual funds, of currencies, of commodities, these particular gains would be reflected. So you'll have to show this particular amounts and pay taxes accordingly on the basis of the disclosures or the reporting that has been done by the relevant participants or the depositories. Like in case of mutual fund, the broker does. Okay, so reporting would be there for both purchase and sale transaction. It is already been in place for the other like shares and mutual funds, and simultaneously we are expecting it for the cryptocurrencies as well. Next is the tax rate. Now, what would be the tax taxing these cryptocurrency gains? No guesses. As I said, it's a regressive scheme. So they could adopt what we say in lottery, or what, because again, windfall gains are really high. So the government could take a plunge on the extra revenue that the person earns, a tax slab of higher tax rate of 30% on these crypto gains. However, it may be lesser as per the government policy. We are just anticipating in here, like what could be the expectation or how we expect things to happen. We want it at a lesser rate, but let's see what. Set off and carry forward is also an important component. So the losses and sale of cryptocurrency would not be allowed to be adjusted from other income and could not be allowed to be carried forward. Thinking it to be a regressive move, or I should say, the government could categorize it into any form. So again, it depends upon the government. As far as my understanding says, they might not allow taking to be a regressive policy, but it can be allowed, it cannot be. Let's keep our fingers crossed till the taxation part of the cryptocurrencies is not announced in the budget. Let's move now to the second assertion that is very, very, very important as per my understanding. That is the concessional tax regime for partnership firms and LLPs. A flat rate of 30%. You could that the domestic companies have been, the government has reduced the tax slab percent. For the manufacturing, it is even lower, 15%. So you can see that the tax slab for other entities, societies, HUF individuals, domestics, it's already lesser. Then why such a heavy or a higher tax rate for the small businesses? Because partnership firms usually run a small business. In instances, they can even run bigger businesses. LLPs are already running bigger businesses. Like the service sector has grown tremendously in the LLP format. So we are recording a higher volume and turnover, but the tax rate is 30%, and there is no concessional scheme or a second scheme that we see in case of LLPs and partnership firms. So I want to insist government to add upon a concessional scheme for taxation, because people are foraying away there. Everybody that is coming to our window, even we are suggesting them not to go in for the LLP or partnership arrangement and directly go into the domestic company format, because in that particular case, they are going to save more taxes. Then what is the entire purpose of coming under this partnership firm or LLP umbrella? So to promote these entities in future, I guess the government should consider reducing that particular tax slab. And if we talk about that, whether there are certain concessions that are in place, so I see that there is also section 44 AD or ADA that is applicable to partnership firms and not LLPs. Firm, that is the presumptive taxation part. So they can have the benefit of presumptive taxation. But again, say suppose if a partnership firm has a total turnover of say 1 crore and they have a margin of 10 lakh, 10%, that is 8% the presumptive scheme, and they are showing it at 10%. So 1 crore, 10%, it becomes 10 lakh, and for 10 lakh, 30% is the tax rate. So 3 lakh is the tax. So it's a bigger turnover component. So I really feel that this particular rates are a little higher, and they should be given a more prudent and reasonable preview by the government and should be lowered down. Do not match it to the company level. You can make it 25% at least, or even a bit lower. I mean, 23%, 22%, that would be fine. That would be good for these. Concessional tax regimes for partnerships and LLP is expected, and I have also written under my recommendation that I have sent to the finance ministry that this concessional tax regime should be in place. Next, we are coming to tax in a single installment, that is section 44 AE for presumptive scheme. So now what the thing is, as I said, that we are also going to discuss about the and the things that are not consistent with the other sections in the act. We are writing to the government to align all the provisions so that there we don't have to check the acts time and again. If the simultaneous provision runs parallelly or equally in the other sections also. The presumptive taxation umbrella, we see that otherwise for paying of the advance, we have 4 installments, that is 15th of every last month of the quarter, that is 15th June, 15th September, 15th December, or 15th of March. But in case a person is covered under section 44 AD or 44 ADA, the 100% of the advance tax is payable by 15th of March, just in a one lump sum installment. So apart from the 3 payments that we made, just one payment is required, and that too in advance on 15th of March 2020, 15th of March, depending upon the year in which you are assessing for that particular individual. But the same thing is not flowing on section 44 AE. 44 AE is basically for the person who is carrying the business of plying, hiring, or leasing goods carriages. Okay, so that particular person has to pay the advance tax in 4 installments for now, because the provision says so. The specific to 44 AD and 44 ADA. Moreover, there are also more presumptive provisions that are under 44B, 44BB for shipping business, for aircraft business, 44BBA. So even if these provisions are like more specific to non-residents, because the premise of the section says so. So if the government is of the view that they want to allow 100% tax payment, advance tax payment, just to the residents and not to the non-residents, even in that particular scenario, under 44 AE, they should allow the advance tax payment in one installment under section 44 AE itself. Let the other section remain separate because they are non-resident centric. But for 44 AE, yes, a consistency or asymmetry has to be corrected by the government. So we have also suggested or recommending this, they should fix this particular error. And for 44 AE also, a single installment advance tax system should come in place, as is going on for section 44 AD and 44 AE. Next, moving toward presumptive business benefit not available for speculative business. So most of us must be aware that this particular provision state that for the speculative business that the entity is, the presumptive benefit cannot be availed under section 44 AD or 44 AE or 44. Now, what this section 44 ADA predominantly says, that an individual or a resident individual or an HUF or a partnership firm, excluding LLP. So LLP does not have a presumptive taxation system, just for partnership firm, as I said. Carrying on an eligible business to declare its income at presumptive rate of 6 or 8%, as the case may be. So like 100% non-cash or 8% if it's in cash also. However, the following persons cannot opt for the provisions of 44 AD. And if we say in AD, there are people who are covered under AE, that is again plying and hiring of good carriage, or they are professionals like CAs, doctors who are paying taxes for ADA, like for professions we have a separate section, or if they are earning income in the nature of commission or brokerage. So all those who are already in this thing and they are showing it as a presumptive income, if they are earning nature of commission or brokerage income, kindly stop doing that. 44 AD disallows, it's a non-compliance of the provision. So yes, so they cannot on agency business. Do we see anything that is written over here which says that a speculative business, a person who has a speculative business cannot file his return or cannot evaluate his taxes under section 44 AD? The answer is no. Even in the rules that have been provided alongside, it has nowhere been mentioned. However, if we see the instructions that are appended to the ITR 4, it specifically states that income from speculative business cannot be computed under section 44 AD. Now, let me quickly show you this particular instruction sheet. I have it over here. Just give me a moment. Just give me a second. So this is the instruction for filing ITR 4 Sugam AY 21-22. So this is for the previous financial year 2021. Downloaded it from the new income tax portal, and we are coming to the second page. See, the return form also cannot be used by person who has any income of the following previous year. It's for ITR 4. Okay, profit and gains from business and profession, which is to be computed under AD, ADA or AE. Such income as from speculative business, agency business, commission or brokerage income, etc. So we see a new term here termed as speculative business. If we move to what we were on, like our presentation, So here it clearly says the section has 4 limbs, and in these 4 limbs, speculative business is nowhere written, if you see. So this inconsistency is a point of litigation, as I suppose, because if you're seeing the instructions, then you have not to show this particular speculative income under 44 AD, or you cannot show this income. However, if you see the instruction thing, however, if you see the act, there is a big inconsistency. So what I suggest is either define a provision of not showing speculative income under the ITR 4 or section 44 AD. You have to include a point E and add that whoever is carrying speculative business cannot file for section 44 AD, just to mitigate or to avoid any litigation point in the future that could arise for. So this is a small observation that we have also marked it to the government this time. Next, higher rate of interest for non-deposit of TCS. So this is again a regressive point that I am, but why I am doing this? Because again, we are pointing out the asymmetry between the provisions. Now, what was happening is for the TDS, we have 2 parallel provisions. For the TDS, if you deducted the TDS, then you have to pay a penal interest rate of 1% per month or part of month. But if you have deducted that particular interest, particular amount, that is lying with you, but you have not deposited that particular amount with the government, then in that particular scenario, you have to pay 1.5% as the penal interest. So there were 2 interests, 1%, 1.5%, 1% being if you're not deducted, second is and collected, but you have not deposited it with the government. So these were the 2 different penalties or penal interest that were in substance under the section 201 for TDS. For TCS, however, in section 206C, there is just one rate. There is rate of interest if the collector fails to collect TCS or after collecting fails to deposit, the penal interest is just 1% of a month or a part of month thereof. So we suggest again consistency should be achieved between the provisions. And for consistency, 1% should be for non-collection and 1.5% should be for non-deposit. So we are asking the government to increase the rates, must be against the taxpayers, the clients, but for the consistency of the provisions, we have made it a point to mark the same to the government. Okay, next moving towards audit for claiming exemption under section 80 IBA. So as all the professionals must be attending this webinar, they must be happy that we have recommended this particular thing, that an audit for claiming exemption under section 80 IBA should also be brought in stance. Now, why? All sections providing profit linked deduction under part C of chapter 6A requires an assessee to fulfill certain condition. One such condition is to audited from a chartered accountant and furnish a report of such audit electronic specified form, that is 10 CCB, to claim deduction under section 80 IA. So for 80 IA, we have a profit link deduction and the books have to be audited and a report has to be furnished, and in that particular report has to be furnished in 80 CCB, and only then the person can claim a deduction under 80 IA. Deduction under section 80 IB is also profit linked. This section provides that an assessee deriving profit and gain from business of developing and building housing projects is eligible to claim a deduction to the tune of 100% of the profits and gain derived from this business. To claim, assessee has to comply with various conditions: size of the plot, residential unit, stamp duty value, and the time limit for completing the project. However, the condition to get the books of account audited is not visit for claiming this deduction. So this is again an inconsistency or an asymmetry between there the things are profit linked and you're asking the books of account to get being prepared and audited, but in this 80 IBA there are parallel provisions, same provisions, but again you are not asking the person to furnish a report by the chartered accountant. So we have said that even IBA should require an audit report from a chartered accountant just to achieve consistency between the provisions. So again, I guess this is much clear to everyone. Moving towards the next, enhance the scope to apply for a lower tax collection certificate, like TCS certificate we are asking for. So in this particular scenario, we see can apply to the AO to issue a certificate for lower collection under section 2069 subsection 9. Such a certificate shall be issued if the existing estimated tax liability of the assessee justifies tax collection at a lower rate. This benefit is only available to person who is covered under the subsection 1, like 206C1 and 206 of section 206. Okay, so 1 and 1C, but we see that there are newer provisions also under TCS that came, like they are 1G, 1F, 1H. 1F is for remittance of foreign currency, 1G, and for sale of goods, 1H. That was 2020. So does not have an option to approach the assessing officer to issue a lower tax collection certificate. I don't know why, but we believe this lower collection certificate benefit should be extended to these particular sections. In 206C should also incorporate 206C9 benefit should also incorporate 1G, 1F, and 1H. So this is also how to increase the scope. Amendment in section 36(4)(a) with amendment under section 80 CCD. As and when I say 80 CCD, we are talking about NPS, new pension scheme. So what happened was section CCD, you all know, was amended by the Finance Act to provide that the central government employees shall be allowed a deduction of the amount deposited in the NPS in respect to a contribution made by the employer to the extent of 14% of salary. Earlier was 10%. So it has been increased to 14% for central government being the employer only, not in other cases. 14% of the salary. Post amendment, maximum admissible deduction in case of an employee would be as under. So 14% of salary if the contribution is made by the central government, and for others, what would be the limit? 10%. 10% of the salary if the contribution is made by any other employer. This is clear. This is 80 CCD. Now, what we are asking the government to correct is to allow deduction of such contributions. Section 36(4)(a) provides that deduction shall be allowed to the employer in respect to the contribution made by the employer towards NPS to the extent it does not exceed 10% of the salary of the employee. Okay, so where is the 14% thing that has been amended? So that is missing in this particular section. And that is why we have written to the government to increase this particular 10% to 14% and bring about the consequential change in 36(4)(a) to bring harmony between the two sections. So the only thing is they have to add up a twin condition, just CCD, that if you are a central government person, then 14%, and otherwise 10%. So thus that has to be done. This is not done. So we are also expecting this amendment to come in. Next, tax deducted in the foreign country to be treated as income of the person. Now, this is a good provision. This is a good, a good thing that we are discussing for now. 198 of IT Acts provide that all the sums deducted at source under the Income Tax Act should be included in gross total income of the assessee. That's more obvious. Whenever you are computing your salary income, TDS that has been deducted, that also forms part of your gross total income. And after that, you calculate the taxes, and at the end, you reduce the TDS that you have paid for from the final tax that is paid. Okay, so this is how things work. We take the gross amounts. But if you read the section once again, let's read this particular line, that all sums deducted at source under Income Tax Act. If you see the highlight of the heading of the discussion, it says tax deducted in foreign country. So withholding tax, what they call it TDS in the foreign countries. So that is basically excluded in, it says under the Income Tax Act. So if a person is working, say in the US, and he has certain part of salary there, and certain part of TDS or withholding tax has been deducted by the particular state or the country. So in that particular case, the net income, that is after the withholding tax income, has to be considered for like making it taxable in India. If he's a resident, not ordinary resident, RNOR, whatever the condition is, but that particular income has to be taken up net, because what we see under section 198 is the only TDS that is deducted under the Income Tax Act and not under the other foreign withholding tax. So this is what I have written. However, the computation of income is often disputed if the cases have been withheld outside, if the taxes has been withheld outside India, and the corresponding income is offered to tax in India. In the absence of an explicit provision in this regard, includes the net income, that is amount to be remitted to India after the withholding tax. Like 100 rupees is being received by him, after 10 rupees being deducted, so he'll not 10 in that particular case, because the provision says so, he takes 100. However, in contrast, the assessing officer assess the gross amount, because the fundamental view is that you have received a total of this amount, and the amount that has been deducted is your foreign tax credit that you would be claiming. So the conflict arises due to the absence of the reference in section 198 of taxes withheld outside India. Section 198 provides a deeming fiction with respect to taxes deducted or collected as per the provisions of Income Tax Act, and does not include taxes withheld outside India. So they are just specific to the Indian landscape only. As per the taxes paid outside India are eligible for foreign tax credit under section 90 and 90A, read with rule 1. Apprehended that the amendments be made in section 198 to bring that the income earned outside India is at par with the income earned in, that is the gross income should be considered. So whatever the situation or the parity is going on between the litigation is going on, that whether we have to take the net or gross, let's make it fast. Let's make it clear that it has to be gross and amend this section 198 accordingly. So this is also an asymmetry that we are discussing. Section 54B, that is exemption to be allowed before the sale of an agri land. So this particular section says, section 50 provides for an exemption to the individual or HUF from capital gains for transfer of agricultural land. The exemption is allowed if the capital gains are invested in a new agricultural land within the prescribed timeline. So what is there in 54B? This particular, in case of other like residential house, or if there is other house, when the capital gain arises from the transfer of agricultural land is invested in another agricultural land within 2 years after the date of transfer. So there is just a single condition limit that after you sale of that particular agricultural land, only within 2 years of that particular sale, you can actually buy another agricultural land and take the benefit of section 54B. However, in section and 54F, we see that this particular exemption benefit or this particular, just give me a second, this particular exemption benefit or this particular limit is even allowable in advance. That is, a person can buy a particular land before and then he can sell. So in 54F, we see that if the assessee purchases a residential house either within 1 year before transfer or within 2 years after the date of transfer of the original asset, he can claim this particular deduction. But it is not the same case in 54B, because there is just one condition that only you can buy the agricultural land after 2 years of the transfer. So that is what we have asked the government to correct for or make an amendment for, is that the provisions should be consistent, and even a prior purchase should be given an exemption under section 54B for agricultural land. There is no much of a stance of not allowing this particular exemption if the land is brought in advance to the particular person. So this is our contention. Next, section N, that is TDS on cash withdrawal to be amended. So this is also a good point of thing that the team has marked out. So what they have, what we see is section 194 was introduced by the Finance Act, subsequently substituted by the Finance Act 20. This provision required deduction of tax at source from cash withdrawal by a person from his account maintained with the bank, cooperative. So now if we see this particular condition or deduction, so it is specifically saying deduction of tax at source, and that is they are talking about TDS. Whenever we are talking about TDS, like in the previous discussion also I talked about TDS. So we are taking the income, and on that particular income the TDS is deducted. That is the premise of section, that is the premise of TDS. Cash withdrawal, if we see that where is the income, cash, it is a transaction. The purpose of TDS is revenue, like advance collection of revenue. The second thing is transaction tracking. Advance collection of revenue can only be done on income. It cannot be done otherwise. However, if the tracking is the only or the sole purpose, then this tracking has to be called by some other name. Because if we go by the provisions, how TDS came in stance or what section 4, section, it is very clear that until and unless you have an income, there cannot exist a TDS. A TDS can only be there if there is income. And in case of cash withdrawal, there is no income, because if you are withdrawing certain amount of cash, how can that be your income? So for TDS to work for, income is essential, and that is what is stated in this discussion that I have written over here, that as per section 190 read with section 4.1, the income has to be first and then the TDS has to come into substance. But in this case, the only objective of the government is revenue, the transaction tracking, and in that particular case, TDS has to get another name. This provision explicitly provides that the collection and deduction of tax shall be made in respect of income of the assessee. If the amount received could not be categorized as income in the hands of the receiver on which tax is leviable, no tax can be deducted or collected at source. So the premise or the very foundation of the provisions goes wrong in 194N, that the TDS cannot be instanced. TDS on cash withdrawal was introduced to promote a cashless economy and discourage payment in cash. Section 184 requires deduction of tax from the amount withdrawn from the accounts. However, it contradicts with the provision of Section 4 and Section 190. That is the very premise of TDS. There is no income component in cash withdrawn from a bank account. Thus, the question of TDS should not arise. The Supreme Court has also affirmed this proposition that if a particular income falls outside, then TDS provisions cannot come in. Even the Madras High Court has upheld the following view and has asked the government even to correct this particular stance. And we are also recommending the government to kindly either give it a separate name, either make a new provision for tracking. Not called TDS. Please don't call it TDS because it is actually not TDS because the classification is going wrong. So this is a small observation and this is what we have asked the government. Section 80DD must be rationalized. Okay, so let me bring on all the slides together and then we will start up. Okay, so in 80DD, what we see is the deduction is the amount paid or deposited in a scheme of LIC or another insurer, maintenance of a dependent person. However, the following two conditions have to be satisfied to claim the deduction. Now, if you want to claim this deduction, you have to satisfy a dual condition. The scheme must provide for payment of the annuity or lump sum amount for dependent only in the event of death of such resident individual or member of HUF. Second harsh condition, assessee nominates either the dependent or any other to receive the payment on his behalf for the benefit of the dependent. So death is mandatory for 80DD. This is what is coming up. These conditions are really harsh and illogical as a person cannot get the lump sum amount or annuity amount of insurance policy till he is alive. And this cannot be in any stance become the view of the government or view of a provision that you cannot receive a particular amount while you are alive or the benefit till you are alive. Even if he has paid all premiums and need the money for the benefit of the dependent person, not get the majority amount till the person is alive. Okay, Section 80DD also lacks the following aspects. It prescribes the meaning of disability as contained in Person and Disabilities Act 1995. This act has been repealed. Now, where you have defined that particular disability part, the act that is governing this particular definition has been already repealed. The new laws, the Right of Person with Disability Act 2016 covers more disability types now. And non-resident persons are not allowed to claim Section 80DD. It is only available to residents. And for the policyholder, the whole amount received is fully taxable because the dependent is the person who is paying on his behalf. And if he dies before the policyholder, the whole amount that will be receivable becomes fully taxable. So it is highly recommended that the government streamline the provisions of 80DD. It is grossly wrong. I mean, अब हिंदी में ही बोलूंगा इसको, भाई इससे तो ठीक कर दो यार, इससे तो मतलब these are some things that are going grossly wrong and the provision should not be like that if a person is not alive, he cannot receive that particular amount or deduction. Amend for this 80DD, rationalize the provision for 80DD. Taxing dividend under the head PGP. This is also interesting. I am sure everybody is enjoying the session because simultaneously, just from the expectation components only, we have asymmetric components and we are actually discussing the income tax provision, like what they are existing and how they can be molded or how they have to be corrected. So this would be an interesting discussion, I guess, because just to cover the expectations would not have been so interesting. So that is why I populated this particular webinar in such a way that we cover the component and the asymmetries, because that asymmetry will automatically become the expectation or recommendation. Okay, so taxing dividend under the head PGP. Now you all know that as per the provisions that are in line under the Income Tax Act, so we see that the term dividend or the word dividend is there in income from other sources, and under income from other sources the clause specifically states that if there is any income from dividend, it shall be taxable under this head, or it shall be computed under the head income from other sources. It can in no effect be computed in PGBP. So this is what I have written. And this in the Income Tax Act, there are 5 heads: salary, house property, business income, capital gains, and other sources. Income from other source is a residuary head of income and sweeps in all taxable income which fall outside the other 4 heads of the income. The provision relating to taxability of residuary income are contained in Section 56. Clause 1 of this particular Section 56(2) states that if such income is not all other clauses of this 56(2) states specifically that, like, except the clause 1, it states that no such income shall be taxable under this particular head if such income is not chargeable to income tax under the head PGPP. So if the particular income is chargeable to PGPP, it cannot come under the head other sources. But for this particular dividend assertion that is written in the clause 1, it specifies that dividend shall be taxed under the head income from other sources. So there is a missing line or a missing provision which states that this particular income will not be computed under income from other sources if it is chargeable to tax under PGPP. So that is a missing link, and for that missing link, every time we have been computing dividend income, it has to go in from income under head the other sources, and it cannot in any way come under PGPP. However, this is wrong. Even the courts have upheld the decision. However, the taxability of dividend PGPP when it is connected with the business carried on by the SSC, for example, dividend received in respect of shares held in stock in trade. So we all know that there are two forms you can hold up a share. Either it can be an investment, and from if there you are getting the reaping the gains, then you are showing it as the capital gains. But if you are holding those shares, you are a trader and you are holding those shares in as a stock in trade. You are buying and selling time and again, and that is your business. So in that case, it is stock in trade. And if you are receiving dividend on that stock in trade, in that particular scenario, you cannot classify that particular dividend as income under the head other sources because it is your gain or the business gain. So even the Delhi High Court said that where shares are held by the SSC as stock in trade, then it should not be said that the dividend income would fall under income under other sources as contemplated in section 56. The Supreme Court held that the nature of the dividend income must be determined having regard to the true nature and character of the income. It is recommended like that alike other clauses, that is 1A till the balance clauses that are there in 56(2). I guess there are 11 or 9. Dividend income should be taxable under the head income from other sources if it is not tax under the head PGPP. Thus, how the section should look like what would be the representation now? So 56 subsection 2, in particular and without prejudice to the generality of the provision of subsection 1, the following income shall be chargeable to income tax under the head income from other sources, namely subclause 1, clause 1, dividend. And in that particular bracket, we'll add these words, if is not chargeable to income tax under the head PGBP. So this would be the amendment that we are expecting from the government. Okay. So this was also a good point of asymmetry. Deductions to be allowed for the maintenance charges. So we all know that a new trend of housing societies and apartments is coming up, and whenever we are computing our house property income, we first we take the gross value, like what the GAV or the rental value is, then we deduct the municipal taxes or the local authority paid, then then on the amount we allow a 30% of standard deduction, and if there is any interest that is payable or loan that has been taken against that particular property, that is being disallowed. So that is how we are computing the income from the house property. But these maintenance charges have been like more of a stance these days, because actually few societies this maintenance charge of 5,000, 10,000, 15,000 a month. Even in my society, I am paying around 5,000 to 6,000 a month for this particular maintenance charges, and these are for the upkeep and the general maintenance of the society, like the lifts or like the corridors and everything. So these charges are there, but section 23, that is for the municipal taxes paid, so that is not allowing you to deduct these particular maintenance charges. I know many of you would say that it is automatically coming under the 30% statutory deduction, but statutory deduction was never meant for maintenance charges. It was meant for the general upkeep, repair of the house that is happening, because obviously you are spending something or some amount even on the flats that you have given for or have let out or that are deemed let out, because their regular expenditure or regular annual expenditure on those particular properties are higher. Even if you are computing income for commercial properties and you have given your office on rent to somebody else and getting a rent, so for that particular part, like the paint, the accessory ship, the general upkeep, the everything, you are being covered under the 30% umbrella, and 30% was a substantial amount. But how these maintenance charges have now started to accrue, they become a major component, because 10 to 15,000 for a particular rent that you are getting, 15,000 or 10,000 is a bigger amount. So we believe that under the section 23, you have to have a second subsection, or there should be something else, or there should be an upper capping limit that has to be allowed for society maintenance charges. And that is why we have written this particular thing in the recommendation part, that even for this maintenance charges, the following thing. In the Supreme Court or court cases, we have seen that obviously the government has said that under Section 23, you cannot book these particular amounts because they are not municipal authority taxes that have to be paid. So these are not that amounts that have to be paid, and that is why, for the same reason, they are being disallowed. Just 5 more minutes, I guess. We are on the end of the session only. There is just one assertion or two maybe left that we wish to discuss. Okay, we are on the last yet not the least appeal. So this would be fascinating to like the most of the professionals like me who are actually facing a lot of trouble because of this. So I have kept it as one last, not yet. So yet not the least. So what is that? Proper functioning of government portals. So we want, it is highly recommended, it is highly desired for that all the government portals that are there, site portal, or be it the income tax portal, or be it the GST portal, or be it the FSSAI portal, FOSCOS portal, or be it the Udyam registration portal. I want these portal and other state government portals to function at their best of their ability. At least a person should not, or a client should not, or a professional should not suffer because of non-functioning of these portals just for the only reason that he has approached for the last date. Why should your portal crash even if you have allowed for a particular form filing till 30th December or 31st of January? You should be upright with your capacities and IT backend strategies that you have to allow for every person who is coming to the window of the government to file that particular form. You cannot in any case give a cite a reasoning. It is even in the other countries also that you give a cite a reasoning has crashed, and from the next date you have to now incur a late fees, and then you blame the particular stakeholder that why we are because you have not filed it in time and you have waited till the last date, that therefore your this late filing fees would be applicable. This could no way be moral. This is not moral and ethical. So the government should allow for and adapt to the desired capacities. You know how many people are filing GST return. You know how many people are filing the income tax return. So why you are limiting the capability of the IT portal? You have to adapt that particular capability and give that and extend the necessary thing to the person. What big is a need? And the MCA portal, oh my God, I have been working on this portal from the last 5 years and I see nothing happening for good. Challans, it's not getting submitted at times. The pay letter challans are not getting, the challans are not getting generated. The incorporation gets difficult. You are transforming the portals, you are bringing in new materials, you are adding clauses, you are adding substances, you are giving it a reshape. First upon focus first and foremost on their proper functioning, and then we can accordingly. And that is how I that is what we have recommended or requested the government, that you should fix on these capabilities and instruct the relevant teams or the IT companies who are running these portal or preparing this portal. So this becomes the last appeal, and with that we conclude this particular session. I hope it would have remained a good session. We are standing on the pre-budget phase, and we are expecting the budget to be announced in another 2 days. By 1st of February. On 1st of February also, I guess we'll be holding a session for budget discussion, and we'll be discussing and we'll be matching up how many of our asymmetries or how many of our recommendations have been followed by the government or the new clauses that they bring in, and we'll be discussing them in detail with you only here at CA Club India. So thank you so much everybody for being with me today. I guess there must not be any much of this queries because we are already talking about the expectation part here. We are not discussing on any provisions, but I have made it very clear, or I really tried to bring upon all the provisions, and whatever the asymmetry was existing in the system, corrected. There are n number of provisions or sections that are yet pending, but due to the limitation and brevity of time, the few important ones and of the most basic use that those provisions are. So I've covered all of them there. So these are my contact details. You can note for my WhatsApp number, even my email ID, my website. or the social media handles that I am on. You can follow me there, and you can also ask your queries. Also follow us for the additional updates or the budget related updates that we'll be uploading up there. We'll also be there on CA Club India. And thank you so much everybody for attending the session. I'll request Muskan to come up now, and I'll also stop
Hi.
the screen.
Thank you, Ujjwal sir, for such an incredible session. In case anyone has any doubts, they can put it in the chat box.
I believe today there won't be any doubts. It was an expectation session. However,
Okay.
we have covered undoubtedly the provisions, but I don't suppose people to come up with doubts in the expectation session. They must have enjoyed the session, and that of this expectation session that we are actually anticipating for things that are going to happen in future. Astrologer ban jate hain hum log sab. So let's hope that budget to be good for everybody. All the best. Have a good weekend. And thank you so much, CA Club India, for once again inviting.
Thank you, sir.
Thank you.
Thank you, everyone.